We can examine the correlations between commodity prices and equity prices by breaking the S&P 500 into its component sectors. The S&P 500 is composed of many sectors of varying weights, so let's look at how commodity prices change relative to these different sectors. Our next two charts will show commodity price correlation coefficients with the S&P 500 sectors I just mentioned. As you can see here, we see similar patterns as we saw in the combined index chart with the Dow Jones, S&P 500, NASDAQ, and bond prices. By looking at the different sectors of the S&P, we can see which parts of the economy are most affected by commodity price increases. As you might expect, consumer discretionary companies have had a strong negative correlation to increases in commodity prices. This is to be expected, since the prices for raw materials will directly impact these companies' profitability. Energy prices have also had a negative impact on the consumer discretionary sector and the financial sector. However, if you look at other sectors like industrials or the energy sector itself, we see positive correlation coefficients. This means that as the commodity prices for energy increases, the stocks in these sectors also increase. If you're trying to build a diversified portfolio, you wouldn't necessarily want to include energy commodities and the energy sector of the S&P 500. To truly diversify, you'd prefer to use energy sector commodities and something like consumer discretionary stocks. To further illustrate the declining correlation between consumer discretionary stocks and the prices of the raw materials they use, here's another sample chart. As you can see here, cotton, wool, and rubber, all staples of consumer discretionary products, have strong negative correlation coefficients. What's important to note here is how quickly the correlations have changed. In 1998, all of the correlation coefficients were positive, meaning the prices of both the stocks and the commodities increased together. However, the negative correlation has occurred since 2005, which corresponds with the rise in institutional investors putting money into commodities. We see the same thing in the financial sector when we look at energy prices. For a while, energy prices were positively correlated with the financial sector, but recently we've seen strong negative correlations. It's important to note that these correlations don't necessarily indicate causality. Rises in energy prices have not necessarily caused financial stocks to lose value. However, portfolio managers have discovered that commodities are valuable tools for portfolio optimization. Many new challenges have emerged as investment in commodities has increased. First, the exchanges themselves need to be able to handle a higher volume of trades and have enough trained staff to execute the trades. Increased volatility in the commodity markets have caused an increased risk of financial failure for investors. Traditional investors who tried to hedge against price increases are having to adapt their trading patterns to new, higher volume, more aggressive traders like hedge funds or other institutional investors. This risk of financial failure is important because more consumers have indirect exposure to commodities through their pension funds or by purchasing investments they don't necessarily understand. Ultimately, the increase in commodity prices to near record levels has raised several important questions for investors of all types. First, we need to know if commodity prices today adequately reflect the supply and demand for the goods they represent. There's some concern that commodity prices are in a speculative bubble because of inflows of money through things like index investments or retail investors entering commodities for the first time. Others argue that commodity prices are accurate because of a general rise in global prosperity over the last 5 years. Countries like China and India have a developing middle class, and anytime you have a new group of consumers purchasing products for the first time, you'll see an increase in raw materials as they build houses, buy cars, and consume more energy. Some analysts wonder if we've reached the limits of commodity supply possible, even with potential new investments brought about by high prices. This is especially true for non-renewable commodities like oil or some precious metals. In our next discussion, we'll examine exactly how money has flowed into commodities and try to discover what, if any, impact this new investment has had on commodity prices, and try to determine if today's prices reflect economic reality.